Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and we're getting an update today from Chris Temple, editor and publisher of The National Investor. And we will put a link to The National Investor below this interview so you can follow along with Chris's work. And Chris, always great to get you on the show post FOMC meeting when we had the Fedspeak, and Powell was out there trying to navigate the verbiage that everybody will dissect 6 ways till Sunday about whether they're going to be starting to cut rates in September. There's been some market gyrations on the back of it, paired with some geopolitics. But what was your key takeaways out of the Fed meeting this week?
Well, Shad, I said last weekend that the Fed was almost universally expected to set the table for a more likely than not rate cut in September. And Powell did that. He said that it is now on the table. When you look at everything else he said during the press conference, especially Shad, I think that the benefit of the doubt now goes toward a 25 basis point cut in the federal funds rate when they meet the latter part of September. It won't be 50. He ruled that out by and large, unless we see a major implosion in the economic statistics between now and then. But barring anything that's really unforeseen, they will start cutting in September. It won't be a long series of rate cuts. It'll be over a period of time. But there's a lot of reasons why the Fed doesn't have to wait. And some people argue shouldn't wait any longer. The most noteworthy thing to me, even while he correctly pointed out that they still don't want to declare victory over the war against inflation, he went really out of his way to stress that, okay, we've seen the unemployment rate tick up several tenths of a percent. We've seen some softening in the job market. That's all I want to see. And anything beyond that, we're going to be concerned that we have waited too long and we'll start to cut more aggressively. So I was taken mostly by how much he stressed the fact that we don't need to see any more cooling in the labor market. We've seen enough. And so he'll be reacting more to that going forward than he will inflation. And that was noteworthy. And he also kind of half admitted that the inflation or the jobs numbers rather that have come out, even as unemployment has ticked up, have been overstating arguably the actual health of the jobs market. And one reporter who asked him that question about government hiring having made things look better than they were, he kind of acknowledged with a wink and a nod without coming right out and saying it that, yeah, you're probably right. So they do want to start cutting, as inflation has come down and they've not moved on the federal funds rate, real rates have thus gone higher. And so there is some room for them to cut a little bit. I still think the markets are, out to lunch and thinking they're going to have a massive series of rate cuts in short order, but they are going to move.
Well, let's dig into that concept a little bit because, to your point, the markets have been front running this rate cutting cycle really since the end of last year. People need to remember we came into this year expecting 7 cuts. So far, we haven't got the first cut yet, but we've seen a big surge in small cap stocks, Chris, because their cost of borrowing would go down in a rate cutting cycle. But to your point, if it's only 1 or 2 cuts and it's not a huge series of them, is the market getting a little over its skis on this small cap rally idea?
Well, I think it's getting over its skis generally, Shad, on that whole idea that when the Fed starts cutting, it's not going to stop. The market still are making a mistake of having in their heads this binary outcome idea that we're going to cut all the way back to a very tiny short-term federal funds rate. And that's not going to be the case. I didn't hear him say it yesterday, which also surprised me a little bit. But Powell in the past has made the point that when we do cut interest rates, it's going to be a mid-cycle course correction or an adjustment because they have enough under their belt so far with bringing inflation back down that, okay, maybe 5.25% to 5.5% on a federal funds rate is overkill. And we can take, a few chunks of 25 basis points at a time off of that and see what happens. They correctly have pointed out that there are still some upward pressures on inflation. And the other thing I think that investors in the markets have to understand over the balance of the year is that the comparisons year over year are about to get difficult for the Fed. Don't forget that it was at the end of 2023 that inflation had come down fairly sharply, and that was getting people to anticipate a lot of rate cuts. It was getting the Fed, as you pointed out, to predict several rate cuts for this year, which they since had to take back when the early part of this year showed inflation rebounding. Well, those lower inflation numbers from the last several months of 2023 are now going to be your benchmark where you're looking at year over year declines in inflation. It may not be as much as what we've seen in the last few months. And indeed, with energy having bottomed and seeming to be treading water here, that's a potential wild card because thankfully, for those of us that are traveling in the summer, we have not seen the kind of pop in gasoline prices that I was thinking that we might get. But the statistics now are that production, which has been at a record in the US, oil-wise for a while, has been plateauing. Rig counts are down. The amount of oil and gasoline and even now natural gas going into storage has been dropping. So we're not likely to get a whole lot of help going forward as we have had in the recent past from energy costs. So between that and the tough year over year comps, the Fed is going to find itself in a place come December when they might be thinking about cutting rates for the second time. Well, oh boy, maybe we're going to just cut once or twice, and then that's kind of going to be it. So we'll see what happens. They right now have still got a cushion of so much liquidity in the markets that they can make a little bit of a mistake for a while, but not forever. And that's why, we're recording this, of course, on Thursday. That's why we saw the markets get shellacked again today, is that with weaker economic statistics out, people are suddenly afraid that, oh boy, the Fed really did wait too long already, and the lag effects of their rate hiking gambit for so long are now starting to take hold. And can the Fed even avert a recession if they start cutting in September? Arguably not. And this shouldn't be a surprise to anybody because historically the Fed never pulls off a soft landing. They always move too late, both on the way up when they should have moved faster to arrest the inflation that they unleashed, and now on the other side. So, nothing that we haven't seen many times before.
Yeah, 100%, Chris. I think the statement behind the curve comes from the Fed being constantly behind the yield curve on either side of it. And yeah, they waited too long to start the rate hiking cycle, thinking inflation was transitory, the inflation that they helped create. And now they possibly have waited too long to start loosening policy. And when you look at the bond market getting a bid and you see rates coming down, a lot of people, that's in anticipation of these rate cuts. But we were talking off mic that a lot of times in the economic cycle, people have been pointing to the yield curve inverting, and it's been inverted for about a year and a half now as a signal that the recession was imminent. But really, it's when the yield curve starts to steepen and when you see it uninvert and normalize again that you're actually getting closer to an economic contraction. So, do you think that's going to play a factor in the markets as the yield curve uninverts combined with this weaker data? Are we getting closer to possibly a recession or a contraction?
Well, I think we are. I think if you look at the fact that the jobless claims were at an 11-month high that were announced this morning, the jobs numbers overall have been, I think, overstated and exaggerated to the upside. I think that when you look at businesses and whatnot, things are tough. If you look at recent statistics, as far as consumer credit, the delinquencies on credit cards, on subprime auto loans and things like that, there's a lot of stress out there, and there has been for a while. You're seeing, news come from retailers, from the delivery companies like the FedExes and UPSs of the world, et cetera, that show that consumers have been buckling now for a while. And the official statistics have not really reflected this for a variety of reasons. It's a whole other discussion. So yes, I do believe we're moving toward recession. But this recent phenomenon of the yield curve getting out of that inversion or coming close to it in the recent past has another component that hasn't necessarily been the case in the past. And this is going to bear watching. And that is that the short end has come down way in advance of the Fed doing anything, and very much so front running that. the knee-jerk reaction of people going long treasuries in just the last few days and, inverting the yield curve back a little bit more, again, has to do with this muscle memory that the markets still have of when, the logical next step when you're going to see the Fed long since done tightening rates. It's been a year now since they stopped where they're at. And now they're going to go the other direction. Everybody's trying to get out ahead of that everywhere along the yield curve. But there's something different now, and it reflects the bond market still understanding that there is such a gargantuan supply of U.S. Treasury debt that needs to be financed and or rolled over going forward. $2+ trillion deficit per year, recently at a higher rate than that. And that's when we've allegedly had a good economy. What happens when we do go into recession? What's the deficit going to be? 3 or 4 or 5 trillion? It's just crazy. So there's not going to be a lot of room for the long end to come down. And I think you're going to see in the next 12 to 18 months, the Fed, which right now has a federal funds rate at 5.25 to 5.5%, they may come down to three, somewhere in a range of 3 to 4%. Yet long rates are not going to move down that much, and I think arguably will move back higher when the markets come to understand in the coming few months that we've seen all of the decline we're going to see in inflation because there's a lot of structural reasons why it's going to stay elevated. So you could have, 150, 200, 250 basis point difference between the long end and the high end. Now, the good thing about that to some extent will be that it keeps the banking system at least in some decent health when you've got a decent spread there from lending short and then getting higher interest rates back in. But by definition, it's going to crimp the economy even further. And you're going to have to be a whole lot more credit worthy to be able to borrow whatever money is out there that the U.S. Treasury is not gobbling up in the marketplace. So this is the outcome that we're heading for, but not one that most people are understanding. And the question is, how long is it going to take? We're probably going to be into 2025 when we realize that this higher for longer for inflation, even if we flatline at 3 or 3.5% inflation, that's well above the Fed's target. And it's not going to allow for the long end to come down that much, especially with all the supply that Uncle Sam has to sell into.
Yeah, a lot of money the government has to raise through bond auctions, and they've been well bid recently, but they also had gone through a whole period where they weren't. And it makes you wonder by next year who's going to be buying these bonds, especially when many foreign nations are actually decreasing the amount of U.S. treasuries that they hold. And if you combine that with stickier inflation, even if it stays at, like you say, 3% or, in that range, that's on the back of prices that have already skyrocketed over the last 4 years, much higher than they were prior to the whole pandemic shutdown and what we've seen the last few years play out in inflation. So is this all setting up for something we've discussed a couple of times on the show with you, Chris? Stagflation. Are we getting into this environment where we're going to have stickier inflation, a slowing job market, maybe a tick up in unemployment, and slow growth? Is this all setting up for a 1970s-esque kind of environment?
Well, it already is. And we've already got that to a very great extent. And again, when we see GDP numbers, which for the second quarter here in the US came out well above expectations again, they will undoubtedly be revised downward somewhat. But that takes into account economic activity and also financial activity. So the fact that you've had the financial markets do as well as they have, real estate until the recent past has still stayed levitated. That's finally starting to buckle a little bit more price wise and so forth. This doesn't reflect the actual health of the average U.S. household, and it hasn't for a while, I think you can argue. So, you talk to Joe Sixpack and Sally Soccer Mom, hell, they've been living stagflation out for the last few years. And it doesn't matter whether the Fed says, well, it came down 1 or 2 tenths. They didn't see it come down 1 or 2 tenths. And you make an important point that a lot of people, this is lost on them, and especially on the politicians in Washington who are trying to put lipstick on this whole economic and market pig that they've given us, is that, yeah, you may only have the year over year rate at 3%, whereas it was 8 or 9 for a little while there back a year and a half or so ago. But it's a 3% increase on what's already gone up 20 or 25% since the pandemic. So, this isn't getting any easier for the average household. And as we go into this next recession, which will be different in some respects from previous recessions, you're going into this recession with arguably households not in worse shape than they were going into the housing bust in 2008. The mixture of things is different. The real estate market is not nearly as leveraged, thankfully, at least where residential real estate is concerned, as it was back then. People learned their lesson. Now, this time around, you've had credit cards and subprime auto loans replace the problem that previously was represented by subprime mortgages. So I guess if you smooth it all out, it's less bad, even though it still leads to consumers who are going to be pulling their horns in a lot more. But when it comes to businesses, when it comes to commercial real estate and things like that, they as well are now going into recession with debt levels overall, when you take everything into account, a third higher than they were just 3 or 3.5 years ago. And that's not going to allow for a whole hell of a lot of growth, especially if I'm correct. And longer term borrowing costs really don't come down that much, even when the Fed starts cutting short term rates. They'll keep the markets maybe from imploding completely by doing that, but they're not going to help the economy. They really can't.
Well, it's an interesting point because the higher for longer narrative, even if they cut it by 25 or 50 basis points or do a couple of 25 BIP cuts, the cost for businesses to borrow is a lot higher than the Fed's fund rate or than the 10-year rate on the treasuries. A lot of businesses are borrowing at 7, 8, 10%. Same thing with auto loans. A lot of auto loans are in the 8 to 10 to 12% range. Credit cards are up in the 20s. So the average consumer is getting clipped, and so is the average small business. And we haven't seen that play out. It's a process, not an event. So it's going to be interesting to see what happens. What does all this mean for the universe that we swim in the commodity sector and the resource stocks? What do you think does well? What do you think may be under pressure in the commodity sector?
Well, what's going to do the best, at least near term, and we've seen this in recent days, is the gold price, because the gold price is reacting to a lot of uncertainties, not just the uncertainty about how bad this impending recession is going to be and how much the Fed is going to have to get aggressive now, maybe trying to cut short-term interest rates. That's going to be very bullish for gold. The trouble is that when you look at other commodities, and you and I talked off mic about copper, copper was at an all-time high back a few months ago. It was 520, 525 a pound, something like that. We almost touched $4 several days ago. We had a bounce that went literally through yesterday for a while, where it bounced back to 420. Because again, the markets, everybody's algorithms are, if the Fed's going to signal a rate cut and the dollar's going to weaken, then you go long some commodities. And that's completely reversed again today, with copper on the back foot once more, because now it's going to react to recession. And that's going to be, for the time being, the challenge that commodities outside of gold have, is that yes, you might be seeing a cheaper dollar as the Fed gets ready to cut, although everybody else is cutting rates too, so it doesn't make the Fed that big an outlier. The only difference right now is the Bank of Japan, which is tightening modestly, but compared to the Bank of England, the Bank of Canada, the ECB, the Fed isn't doing anything different. In fact, they're doing it belatedly when you compare it to the rest of them. So I don't think commodities are going to get a whole lot of help right away from the Fed, as the economic statistics continue to deteriorate in the several months ahead of us, even as the Fed starts to cut once or twice. I think that you've got to be cautious about base metals and so forth. Long term, the supply demand fundamentals for just about everything is bullish, but I fear that for most everything, and there's exceptions we can talk about. We're speaking in general terms here, of course, Shad, But I think for most everything, you're going to see lower commodity prices still from this point as we start to go into a recession. And it's only going to be when a point comes, and hopefully it does sooner rather than later, that whoever we have as a makeup of power in Washington come 2025 realizes that we've got to do something of substance to stimulate the economy anew, but it's got to be something productive. It can't be just throwing money at unemployed people or people sitting at home. It can't be that kind of a thing because the debt level is already chaotic and it's going to really trash things sooner. You need to have something like a major infrastructure, energy type of thing where at least for Washington, doing something to try and prime the pump again, which is inevitable. At least you've got good paying jobs and stuff that we actually need for the economy. And I think that if that policy comes out and it's done right, that will be the foundation of a much longer and durable secular bull market for commodities, which I believe that is coming for a while. We've seen it in fits and starts in the last few years in a few different places. And it's the reason why the copper price, hit a brief high when that story started to get a little bit better known, even though now it's going to take a backseat to recession worries. So you've got to be careful of most everything else going forward. I think where it still is right now, natural gas is a screaming buy. I think it's asinine where the price has been lately. Here again, you've had algorithms and speculators that have piled on to a market that, okay, maybe natural gas shouldn't be $10, but it shouldn't be, down near two either. So that still, I think, has got some room. And you know me, I've loved uranium for a long time. We got our people in uranium before it had a big move. It's about to have the next leg of its bull market, in my view. After the cash price for uranium corrected and it's been treading water, it's almost to be overtaken now by the long-term contract price. And I think that's going to light a fire under uranium again. So you got that, you got natural gas, you've got gold. Those are probably not necessarily in that order, my top three stories right now.
Well, and Chris, you bring up an interesting point when you talk about supply and demand, because even if demand falls a little bit in a contraction or a recession scenario or whatever's happening with China, same kind of story, there's still the issue of supply coming online and the need for governments to help, not just on the funding side, but on the permitting side and speeding up timelines. If the world wants to have AI data centers and EV charging stations on every corner, and they want to continue with crypto mining, you're going to need a lot more copper. You're going to need a lot more energy, not just the transmission of energy of copper wires, but you're just going to need more power. So you're going to need things like nat gas plants. You're going to need things like nuclear plants. But the problem is the choke point is going to be the raw materials, pulling them out of the ground. Do you think eventually the supply deficit becomes so extreme that even in a recession, commodities could rally just because there's not enough of them?
Oh, I think that absolutely will happen. And again, I think the people right now that are selling or shorting copper are short-sighted again, just like the bond traders and others I mentioned earlier, Shad, with a muscle memory of, okay, we're going to recession. It's time to short copper. You know, all right, you might get away with it for, a few weeks or a month or two, but you're right that ultimately that is what comes back. And partly, as you also just pointed out, it's because of horrid policy decisions. I mean, there's been a couple of pieces of legislation going through Congress recently. I was talking with a couple of congressmen a week ago at an event up in Duluth, Minnesota, put on by Better in Our Backyard. We were talking about some of this legislation, both of them, Tom Tiffany from Northwest Wisconsin and Pete Stauber from Duluth, who represents the whole Iron Range area up in upper Minnesota. Of course, we know what they believe. They're both smart guys, Republicans. They know that we need to produce these raw materials within our own four walls. But what few accomplishments there have been in Washington policy wise are a pimple on a flea compared to what we need longer term. So, ultimately that message will come home, but we're going to go through a lot more pain as a country first. We're going to have to import more. We're going to see our own domestic industries languish further. If we get an administration and a Congress after this November that realize that we've got to have a crash course plan to do what should have been done for the last several years. Maybe things will be mitigated, but yeah, I mean, there's shortages as far ahead as the eye can see, and especially when you talk about these data centers and things like that, they're not powered by fairy dust as much as some on the left want to believe that they are. So we're in a lot of trouble, and it's self-imposed as a country. It's not a whole lot better in Canada.
Yeah, great point. And I think that we're going to see more choke points on the energy grid the more this build out happens. And it just underpins things like natural gas, nuclear power with uranium. And even people are still not weaning themselves off coal yet. And while there may be a push for renewables, if you want a bunch of solar panels, it's the same issue. You're going to need a lot more silver. So almost everywhere you turn, windmills, you need rare earth magnets. So everything requires raw materials to come out of the ground. As far as people listening in that are investors, how do you do it in your own portfolio, Chris, or with your subscribers? You don't have to name the actual companies, but are you more interested in the producing stories for copper or uranium or nat gas, or do you like the development stage stories or the exploration stories? What trips your trigger in the commodity space?
Well, I like the stories across the board, but one of the things I've been increasingly stressing, Shad, and it's regrettable that we're at this place, but you can have a great exploration story out there in North America, but if you're not with a company that has an existing big brother in the terms of an automaker, one of the big battery makers in the world, or in the handful of instances where happily we have seen this, some support from the Department of Energy or the Defense Production Act, money from the Department of Defense. Um, I'm increasingly standoffish. I've been actually advising that we sell some of the stories that we've been in that I otherwise like in favor of stories that are as good or better, but have got one or more of those big brothers there. Because there's still, in a lot of these base metals and battery metals, a lot of stories out there. A lot of them are promoted heavily where we've got a great lithium find, we've got a great nickel find, we've got a great copper find, whatever. Okay, well, so does everybody else and their dog and the fleas on a dog. Do you have Tesla getting in your corner? Do you have SQM getting in your corner? Do you have the big battery makers or Stellantis, any of these other car makers getting in your corner? Have you caught the eye of government yet and have gotten some money under the IRA or Defense Production Act or from the Energy Department? If you haven't, you're way down at the end of the line. And yeah, you might be a great story, but no one's going to really enjoy it for 5 or 10 or more years because of permitting and stuff like that. So you got to be careful. And look, I don't say that because I like that environment. I don't. We shouldn't be at a place like that. There's a lot of things that should be developed right now in this country where we've got the ability to supply all of our copper needs. If you took, Shad, every single development stage project for copper in the US, mostly in Arizona and in Minnesota. Okay. And there's a couple of other projects. US Gold has got a great gold and copper project that's state permitting. So they've been moving along nicely out in Wyoming. But even if you had every one of these things developed now or going into development now, you still can't do it all because part of the poor planning on the part of our so-called leaders is you don't have the workforce that could even run these things if they were permitted. And that's a part of the whole story that has not gotten enough attention. You got kids going to school these days to learn how to carry protest signs or deface statues or do whatever. You don't have people going to school to learn how to be well site geologists, hard rock geologists, engineers, run a mill, run any other part of the supply chain for all of these different things that we need. So this is across the board that we've had no leadership from the top, and the markets have not been allowed to really work either when it comes to this stuff. So, I said back 2 summers ago, if you recall, when we had a huge spike in natural gas, we had record high gasoline prices, that this is just the first episode of what's going to be a rolling energy and commodity crisis that we're going to deal with for years. Most of it's going to be over shortages. So we're going to see down the road price spikes for a lot of these other commodities as well. And it's going to be because we've had no leadership and we're now at a place where we can't meet our needs.
Yeah, such a great point, Chris. And it's going to be interesting to watch when all of these choke points and tipping points come together. if the rubber actually does meet the road, and if we see policymakers yield a little bit on the permitting, if we see more funds come into the sector, because like you say, if you don't have those strategic partnerships with the battery companies, the car companies, or the government, then you have to do dilutive financing as opposed to having some non-dilutive financing come into the project. The other thing is, if people want the supply, they have to remember there's not enough skilled labor and skilled talent, as you just highlighted, and that's going to take years to develop. So it's not like you can just
Right.
flip a switch. So it's going to be wild to watch it play out, but we'll keep following along with it here at the KE Report, and always appreciate getting your thoughts on the market. And if people like getting Chris's thoughts, you definitely should check out the National Investor. I'll put a link to that down below so you can follow along with his analysis. And Chris, looking forward to our next conversation.
Me too, Shad. Thanks for your time, and everybody have a great weekend.